Hello everyone, appreciate you tuning in. Tim Fitzwilliams here, and Mr. Ron Wright, Chartered Financial Analyst. That's the leading manager of our portfolio here at Fitzwilliams Financial and Fitzwilliams Wealth Management. We're doing our CFA corner today, right Ron? We'd like to do this for the clients, just to kind of update everyone on what's going on.
Right.
And there's a lot to talk about, so we're going to try to keep it brief. If you have more questions, you can always call in your advisor and ask as much as you want. That's fine. But today we just kind of want to give you a little bit of an overview of what's happening. So let's just jump right in with the political distortions and the debt ceiling. Everybody wants to hear about the debt ceiling and $1.2 trillion in T-bills.
Right.
What's going on there?
Yeah, you know, the drama that was there for the debt ceiling was amazing. And of course this is normal, right? They always push it to the last second and then they finally get the deal done. The problem though is that even though they've got the deal done, now we're gonna have the lingering effects of what's gonna happen. So before right at the last moment, before they got the deal done, the Treasury, the US Treasury, was down to about $30 billion in their bank account, down from over $1 trillion down to $30 billion.
Mm-hmm.
Now they've got the clearance and they're going to start filling that account back up again. And so their plan is to put out about $1.2 trillion in T-bills and Treasury securities over the summer. And the problem with that is that when you get the market flooded with all of those bills, they're going to soak up all the liquidity that's out there in the marketplace. And they're going to start pulling money from bank accounts, deposits, because
rates are going to be higher.
Rates are going to be higher for these T-bills.
Yeah.
And so there's two effects there, right? One is that they're going to pull money from places that we don't really want money disappearing from. These banks want to have their deposits. But the other side of that is now the Treasury is refinancing the debt at higher rates than they were before. So, you know, if they had done this a year ago, we would have been near zero. But now we're up at 5.5% for these treasuries, and that's going to cost more down the road for the United States.
We just grow our debt even more.
Right, exactly.
At what point does that just have to stop?
Well, you know, that's the ongoing question. Our debt is high, but debt as a percentage of GDP, we're not, but about half of what Japan is. So, you know, it just depends on the economy. So we don't really have a good answer to that question yet.
Gotcha. So as long as they can, they're going to continue to try to kick the can down the road.
Clearly.
And you feel that the banks are going to suffer, that the money that's in the banks, a lot of people that have CDs and things like that would rather look at these T-bills because they're going to be a better return at that point.
Sure. So this is a really interesting time that we're finally getting back into. For the last, I just looked, it's been about 14 years since you could actually get a return on cash.
Right.
And you know, think about how many people have come into managing money in a time when cash did not exist as an asset class, but suddenly it is again. Suddenly now I can put my money into a money market fund and make 5% a year on it. Completely different environment. So instead of being okay with just sticking my money in the bank and maybe getting 0.5% a year, I have this alternative. And so now people are starting to pull their money out of the savings accounts in the banks, out of the deposit accounts, and they're moving it over into T-bills and money market accounts and such. And the problem with that is now banks are losing their deposit base. And it doesn't really impact the big banks, of course, but it's these regional banks.
Small banks. And niche banks that focused on one particular industry might have a hard time going through that and dealing with that loss.
So this is going to be a knock-on effect of the same thing that brought down Silicon Valley Bank and the others. It's really going to impact them in those ways. So this is going to cause more stress on the financial system, and it's just one more reason why we're being very cautious navigating through this.
And they might have to relook at monopoly laws and things like that too, because a bigger bank may or may not be allowed to acquire the smaller bank.
Right.
They'll have to figure out something.
Yeah.
So as the consumer, would you say it's okay to keep your money in the banks? Is it going to be scary, or is it just that, hey, there's another alternative here that you could possibly make more money in than T-bills?
I'm having a lot of conversations with people about that very thing, and we're actually shifting their money over into T-bills or even simply money market accounts
Are we looking to do that inside the portfolio?
So we already have been doing that.
Okay.
We've been taking advantage of that for quite some time now.
That's
As
why
soon
we
as
love
that
you.
became
You're ahead of the curve. We love that. So
Yeah.
now we'll just ride that into this.
right.
Good.
Yeah, so now it just
Okay.
becomes actually an alternative asset within our portfolios.
Yeah.
You know, are we going to make 5% in this, or do we put it in cash where we know we're going to make 5%? So it becomes something we look at.
Gotcha. Some other interesting political things happening. The student loan forgiveness and the fact that people need to start paying it again.
Right.
That's going to kick back up.
Right, yeah, that was part of the agreement with the debt deal that kind of stepped that forward. And so probably, as estimates are September at the latest, those student loan payments are going to have to restart. So people have gotten used to not having this extra payment, and the average student loan payment is somewhere around $350.
Right.
So obviously there's
It's a
a
chunk.
lot that are less,
So,
but
yeah.
that's a car payment.
Yeah.
You know, that's
It could
something
be
that
a
is
used
real.
car payment. It definitely could be a bill of some sort
Certainly.
that you get accustomed to.
Right. And when you talk to people, you know, they didn't put away the money that they didn't
No,
have to
of course
pay.
not.
They
Right.
spent that money.
Right.
So this is going to be a real drag on the consumer because all of a sudden now, instead of going out and buying that new Apple thing, you know, whatever they call it, now they're going to have to make student loan payments again.
Right. So you think that will tighten things a little bit?
Yeah, that's going to be a significant impact to the consumer. And so that's going to slow down the amount of spending that goes on in the economy. So that's going to bring growth.
And loans with
Yeah.
you for the majority of your life. So we're not just talking about younger people that have their student loan. We're talking about professionals and everyone. Just the loan just gets bigger. If you
Exactly.
have graduate-based degrees, then you might have $1,000 or $2,000 a month payment. So I mean,
Oh, at least. yeah.
it can
Yeah.
affect all walks of life. So it is a significant impact.
Yeah.
And
it
that's
is.
probably why they wanted it, because it's significant revenue to the government.
Yeah, absolutely. I mean, the government has given up, you know, billions of dollars in interest that they would have gotten on these loans because they stopped everything. So this is something that they want, and that's part of the reason it was in the deal, was they had to do something to generate new revenue without increasing taxes. So it's
Interesting, very interesting. The hot topic, you can't watch YouTube or TikTok or even have a conversation with somebody without someone bringing up AI,
Yes.
right? ChatGPT,
Yes.
that's all the thing, right? I can
Yes.
tell when I get an email from a ChatGPT person.
Right.
You know, one of the concerns is that it's new, or is it new, right? That's the way to look at it. Is this really new? And are people going to invest millions and billions of dollars into this industry only to find it be another dot-com bubble?
Right. So yeah, that's very interesting. I read an analysis recently that was talking about what it takes to train one of these AI systems. So it really costs, in real terms, about about $500,000 to do one training for an AI system. So that's a big hurdle that system has to overcome in order to become profitable. And that's just one training. You do generally multiple trainings for these things to make that happen. So the question is, what is it going to take to actually turn that into a revenue generator for somebody? Because you can't, even though the technology is out there from a couple of different companies, it's a little bit like saying I own the internet to say I own AI. Because it's known how these things work. It's just a matter of training them and
Not necessarily a
putting it together.
commodity.
Right.
It's a technology that anybody can have access to.
Right. So
ChatGPT may be able to monetize it in the short run, but in the long run, there'll be 10 other different ways to access this type of AI.
Exactly. It's kind of like when 3D printing came out, and everybody thought 3D
Right.
printing was going to be the greatest thing.
Yeah.
But the problem was all the printing companies could create it, so nobody could capitalize on it.
Yeah.
So AI is a great technology. It's going to increase productivity for the workplace. It's going to make it easier to do things. But to actually capitalize on it and say I can really make money on it is a much more difficult proposition.
On the actual technology itself.
On the actual technology. So that's why we saw this.
Byproduct, you might be able to make a little bit more profits.
Yeah, because it enhances the
Your
profitability of
productivity.
your
Yeah,
company.
right.
But that's why we saw this sudden, the boom in stocks like Nvidia and Broadcom, because that's sort of the opening salvo of, okay, what do companies have to have in order to implement this? And the answer is faster computers, faster chips. And those are the companies that build the chips that AI computers
I'm glad you
run.
brought that up, because that boom is something that a lot of people are seeing now. Everybody gets excited when we're in a rally.
Right.
So
Yeah.
are we really in a rally? Is it just a little bit of a spike? What's really going on? Because it seems to me that the majority of the market is being ran by about 7 or 8 stocks.
Right, yeah, and that's exactly right. So, this boom, I heard it recently referred to as, or compared to, a little bit like picking up nickels from in front of a steamroller. It all seems really easy at first, and then all of a sudden it can go horribly wrong.
Yeah, right. Yeah.
The catastrophe that follows. So, just a great visual on that, because it seems like it's easy, but the problem is when it turns, these things really come crashing down. So what I look at is the breadth of the market. When I'm seeing a rally, I want to see that it's broad-based, that stocks across the board are enjoying this, and it's pushing everything up.
Not just an outlier or a fluke.
Exactly.
Because that kind of goes back to your old principle. We're not a hedge fund style where we're shooting for that one special stock that's going to take off because it's got that new release of that new thing that's going to triple the profit for our clients, for all of you. We always talk about our goal is to iron out things, to meet the market in the good times, to beat the market in the bad times, so iron out so that you have more actual cash.
Exactly.
At the end of the day.
Exactly. We want to
this is kind of what we're looking at
here.
You're looking at this thing and saying, is this an outlier or are we really moving? Because last we checked, for those who don't remember, we're in the 5th stage of the macroeconomic cycle that we like to track and that he does his trading off of. And we're talking about moving to that 6th stage, which is the recession. So here we're looking at this rally. That's the opposite of a recession.
Right.
But you're saying it's not really a rally because it's not enough strength behind it.
Exactly. It's not broad-based. So one easy way that we can use to look at that is to look at how the S&P 500 index is actually constructed. So most people don't know this, but the S&P and many of these indexes are actually what they call cap-weighted, which means that larger companies have a much greater impact on the performance of the index than smaller companies.
This is why we heard the thing about FANG.
Yeah,
over the last few
FANG
years,
stocks.
Right?
Now they're calling these the Magnificent Seven stocks that are these mega cap stocks,
right,
that are driving everything. So what we do is we look at the cap weighted index and we look at the S&P equal weighted index. So it's actually an arithmetic average of all the prices.
Okay. More standardized.
Yeah, so it's more of what you really think of as an average.
Yeah.
For the first 5 months of the year, the cap weighted, the size weighted index was up 8.9%. The equal weighted index actually lost 1.4% for the first 5 months of the year.
Economy, the businesses that are inside of the S&P 500 that are not super outliers,
They're not part of that magnificent
they're actually
seven.
down 1.4%.
Exactly.
These special companies that might be hyped behind AI or some other niche of some type is what's showing the up. So it's kind of like a false illusion.
Exactly. And we see these things. This is very typical, the peak of a mania, a market. People call them bubbles. But this is the kind of thing that happens at those peaks. The last time, this year I'm actually celebrating 30 years in investment management.
Well, congratulations.
So, thank you.
That's fantastic.
And I think back across that time and I remember things like the dot-com bubble and how really it actually felt as I was managing investments during those times. And this is very similar. It has a lot of the same characteristics. So again, that keeps us more cautious and ready we don't want to be caught by the steamroller.
That's a really good point. And you don't want to be caught by the steamroller either. So for those people out there that think they're quick and nimble, picking up those nickels in front of the steamroller, if you're not the best nickel picker-upper there is, say that 3 times fast, then you're probably in for some unforeseen drama.
Right.
In short, If you're doing it yourself right now, you're really putting yourself and your family at a lot more risk than you used to be.
Right.
Before, no big deal, right? Market's going up, market has a little dip, goes up. That's just life,
Right.
right? It's not a life-changing event. It's not that serious, right? Everybody was doing okay. But in this situation, it sounds like, to the steamroller example, you make the wrong move or you're in the wrong sector.
Or you just time it exactly right,
Then
and it's catastrophe.
catastrophe.
And that's what we saw with when the dot-com bubble burst. That's exactly what we
So
saw.
are nickels worth it?
That's the right question. That's the right question. So
Hey,
we
Warren
never.
Buffett said, don't take excess risk if you
Right.
don't have to.
One of the guiding principles that we use is that you always have to be properly compensated for the risk that you take.
Absolutely.
And so as we look at the markets right now, we look at our model, our overall, econometric model. There is not one area that we look at that's not flashing red right now. Everything is flashing too much risk. So
And a lot of that is also around overvaluation, right?
yes,
So
yes, that's right.
the S&P itself, because of these heavily weighted stocks,
Yeah.
is overvalued.
Right. So we took a look at what average valuation ratios. We normally use what they call the PE ratio, the price to earnings, and what the average ratio is given different levels of inflation. So we looked at CPI inflation and interest rates. We said, what's the normal for where we are right now? Where we are right now should be around 17 and a half times, but right now the market is about 19 times earnings. So it's valued too high. If we translate that into where we think the level of the market should be, it's about 10% overvalued, which interestingly enough is almost exactly the same amount that the cap weighted index is
The Magnificent Seven are.
Yeah.
So those outliers truly are the overvaluation.
Yeah,
Wow.
exactly.
And that's the concept of a bubble.
Yes.
And if people get excited and put a lot of money into bubbles, that's when they pop.
Right. It ends.
So all it takes
at
is
some
a
point.
few companies fly by nights that become AI professional based companies, automate this, automate that. Everyone's going to pile money into the idea of owning the technology and doing it.
Mhm.
And then it's going to fall.
But at some point, reality sets in.
Everybody was a search engine. Everybody was all that back.
All you had to do was put .com on the end of your name, and you
you're
got
good
money.
to go.
Yeah.
Right. Wow, that's really interesting to look at that even though we are seeing these gains, it's really just a few stocks. And when you look at the bigger picture, those few stocks are what's making the entire S&P 500 overvalued.
Right. Let me put one more nuance to it. So when NVIDIA, which was really what started this, when NVIDIA announced their earnings beat, so they beat earnings by about $4 billion, which is a nice amount of money. That $4 billion beat turned into a $1 trillion increase in the market cap, the value of these AI companies.
So people are flooding in.
So yeah, it just is not, it doesn't make sense. It just doesn't make sense.
So
How would a
I'm gonna
$4
get
billion
that.
beat turn into $1
Well,
trillion?
that's the timing. If you were in and it went up, great.
Yeah.
But you better be watching it and you better be moving. Are we moving in and out of any of that?
No, we're not. We're not involved in.
Not our cup of tea.
No.
Too much risk, right?
Exactly.
We're not a hedge
And
fund.
right. You can't get.
We hedge, but we're not a hedge
Particularly,
fund.
we're hedge fund. Yeah, we don't play that game.
Right.
It's just at this point, there's no way to know if you could possibly be getting adequately compensated.
I just
for
had a
the risk
person
that you have
who
to
is
take.
saying they're about to go all in on NVIDIA.
Yeah.
And that's kind of what we're worried about, is that the people that are not doing this for a living, 30 years of experience, highest level of intellectual capital, as you all know, the Chartered Financial Analyst designation, world class, right? Can't say enough about that. You know, if you're not doing it, it just comes back to the age-old saying that I built my entire company and group of companies around. Do what you do best and trade for the rest.
Right.
If this isn't what you do, get out. Don't do it,
Right.
especially right now.
Yeah.
And I'm hearing people that are kind of on the fence are coming on board with us and stuff, and that, well, you know, I'm going to buy back into this, or I'm going to do that, or it went down, but it's okay, I'll double down, because the idea of dollar cost averaging or doubling down, but eventually you get stuck.
And think about where that terminology comes from. The idea of doubling down.
Vegas.
Exactly. When we study behavioral finance for the markets, in the CFA program, there's a big component of behavioral finance. That's exactly where they went to study how people behave when it comes to money.
Makes sense.
And those behaviors get magnified in times of, like this, fear of missing out.
Emotion takes over.
Yeah, emotion takes over. The actual whatever we're trading may change, but the behavior is still human behavior and it tends to repeat.
That's kind of an interesting question. One might want to play devil's advocate here and say, well, Ron, how come you're not emotional about it? You're a human being.
Yeah.
You have feelings.
Yeah, and I have 30 years worth of experience and some interesting life lessons learned during that time.
You've seen the big money be made and you've seen the big money be lost.
Exactly.
And when we say big money, folks, we're talking about when he was sitting on a firm managing $6 billion in the Merrill Lynch portfolio with a group of other people like him. That's big money. So he has seen it, and you've seen what happens when things go south.
Right.
So
Absolutely.
you remove your emotion and you just use the math and the science to help you make your decisions.
And I wouldn't necessarily even remove my emotions. I would say I remember how it felt.
You use that as a...
Yeah. You remember how it felt, and suddenly you think, this looks like a duck, and it walks like a duck, and it quacks like a duck, so I think it's a duck.
Exactly. That makes a lot of sense. You mentioned something before we move on to the bond market. You mentioned inflation. We've been talking about that over the last couple CFA corners. Where are we at today? Where are we going? And that's going to kind of help us into the bond market conversation that we want to close out with. But
Right.
What about inflation today? Where are we at? What's going on?
Yeah, so we've seen a really good pull down from the extremes. So we hit that 9% level, never hit the 10%, thankfully, and we come back down from there. So we're still though hanging in here around the 5.5% range,
getting closer to the norm, which we would say by the U.S. standard has always been what? 3%, 2%, right?
Well, the Fed's target is 2%.
2%,
and so and they've held fast to that. That's exactly what they're going for. So we've seen that really come down, and a large part of that has been commodity inflation has come back. Gas prices are lower, oil prices are lower, building prices are lower, lumber. All these things have come back down. But what has not moved like it needs to is what they call service inflation. And the Fed looks at this measure that they call super core inflation, which is service inflation minus housing. So they're just trying to isolate what service inflation is aside from everything else. And that is actually stuck very fast. It's really not moving. And that's a problem for the Fed, because if they can't get service inflation to come down, then they're not going to meet their goal.
Could you give us an example? You're talking about in the service industry?
Yeah,
services, things like that?
Sure, hospitality, it could be transportation, it could be software services, anything like this, where it's not that we're producing something and selling something, we're selling the service.
Okay.
So that's what we're talking about with services inflation.
And that's there still.
And that's very sticky, and it always really has been, but the problem is it's stuck at a higher level than it used to be. And so the Fed likely will take a skip next week when they meet, but very likely they'll go again for another 25 basis point increase in July. And that's exactly the opposite direction that the stock market thinks they're going. The stock market
they want
thinks
to cut rates.
Yeah.
But we believe that's impossible to do without a lot of extra problems.
Right.
Can you explain a little bit about that to refresh folks? We talked about in the last CFA corner, but why can't the Fed just go in and cut the rates to try to get things in a better position?
Well, the problem is all about inflation. If they cut rates to try and stimulate the economy, then they're going to put more fuel on the fire once again for inflation. And that's their number one target, is getting that inflation down to 2%. So if they start cutting rates because they want to stimulate the economy, then they're going to recreate what happened in the 70s and early 80s when we saw inflation head all the way up to 18%.
Right.
And mortgage rates 12 to 15% is what it took to get that back under control. So they're very, very focused on not letting that mistake happen again.
That's good.
That's where they're going.
So how's the bond market going to be affected by this? What's its perspective?
So it's very interesting. The bond market has a very different perspective than the stock market right now. Stock market is really priced for perfection. They're priced assuming that interest rates are going to be coming down, that the Fed's going to start cutting rates this year, and that that's going to stimulate the economy, and we're going to be back into full growth again. But the bond market sees things very differently. The bond market is anticipating that inflation is going to remain higher for longer, which means that Fed interest rates are going to remain higher for longer as well. And they don't anticipate any cuts until at least the middle of next year. And even just 1 month ago, the equity markets were anticipating 4 rate cuts before the end of the year.
There's a lot of hype around that, right? So, consumer listening, our clients listening, how do they know what to believe?
Yeah, this is a really crazy time.
It's kind of tricky.
Yeah. So it's interesting you say that. I was thinking about this the other day. We like to say we live in the information age, right? The internet is the information age. But thanks to things like AI, ChatGPT, and what's coming out with all these deep fakes and all these news stories that get disseminated instantly, we're almost in the misinformation age. So it's very difficult to dig through all that data and try and understand what the reality is. So what we do is, instead of looking at the headlines and following those, we go right down into the bowels of the data itself.
The actual profitabilities and
the actual real numbers. Releases. Yep. We look at all 20 pages of the releases, the reports that come out of the government, and
because the numbers don't lie.
That's all we've got to really rely on.
And ultimately, it always falls back to that.
Yeah, fundamentals have always won in the end.
In the end. However, there can be a lot of stuff in between. And that's, I think, where emotions get involved.
Yes.
People believe in something, they get excited about something, they want it to work out, they push for it, like ChatGPT, or what the next version of that will be, and everybody will get hyper about it and want to invest in it. And then, economics will always take over. There'll be another ChatGPT, there'll be another company that's trying to do it.
Right.
There'll be 20 of them if it's truly that, because nothing is going to be allowed to make monopolistic profits unless the government grants you that ability.
Unless it's protected, right?
That's different, right?
Yeah, exactly. That's what we call an arbitrage, right? It's this opportunity to make a riskless profit, and then we say that gets arbitraged out. The market removes that because people jump in to fill that gap, figure out ways to take advantage of that, and then the opportunity is gone.
I remember in economics we called it economic profits, which are above the norm, and then there's accounting profits where you should be.
Right.
And through studying various case studies of product releases, when people think they have a patent or something to control it, sure enough, where there's Coke, there's Pepsi, right?
Right.
So eventually there's more and more competition, and that makes a vast difference in the market. And all of a sudden you're left being heavily invested. Myself, ladies and gentlemen, actually, I was in the dot-com bubble, and I was all in on Palm Pilot. I thought it was the coolest thing ever.
Yes.
I was at the time in a different business that I owned, and I thought it was amazing to manage my stuff from the user endpoint. I was super excited about it. I was like, this is a game changer. Little black and white screen with a stylus. It was awesome. And then the IPO came out. I was awake. I was up. I remember that morning, I finished a class because one of our classes started super early. It was like 7 a.m. because Walter Williams liked to do things. Rest in peace, Dr. Williams, but that's how he liked to do things. Then when we went out to the Johnson Center, and we got on, a couple of us, and sure enough, I put my money in, and through the E-Trade account at the time, and the IPO took off.
Yeah, it looks great.
I was super excited.
Yeah.
My first class came, the 10 a.m. class came. I'm like, all right, I'm going to let this ride.
Yeah.
I got out of my 10 a.m. class, and I was almost all gone.
Yeah.
And I was like, well, we just have to wait it out. Never came back.
And then the iPhone
made so much sense, though.
Yeah.
Right?
Sure.
And like the iPhone, same thing.
Yeah. Then the iPhone hit, and the Palm Pilot disappeared.
Yeah, just completely destroyed the technology that you thought was so great, DVDs, the CDs, right? And now we don't even have DVDs. I was, going through my mom's stuff, and we were trying to kind of throw away some things that she's had from storage, and we were looking at these piles of DVDs and VHSs, and one time you thought they'd be worth something, but now you want to watch the old Disney Vault movies that you can never get, but once every so many years you just turn on Disney Plus.
Right.
So technology and advancements of technology almost always flatten out the spikes.
Right.
Whereas like something is the outlier, the AI, the ability to have that level, well, it's just going to kind of spread out. Facebook was what MySpace was, and Instagram, and it's always the next. So I'm always very cautious of those type of technology-driven companies, because who's going to come out and erase them from the map?
Right. So you always have to be very cautious of trying to grab short-term gains in these kinds of things at the cost of long-term losses.
Exactly.
And we never want to be in that boat.
No, that's exactly right. We want to be more conservative. We want to iron out those spikes as best we can.
Exactly.
And do you have any updates as we close out on the bond market, just to kind of wrap things up? Any updates on our portfolio? Where do you see things going? Are we moving into that sixth stage?
Yeah.
Where are we heading?
Sure. So, from the stage perspective, yes, we're definitely moving towards that sixth stage. The likelihood that we're going to enter into recession before the end of the year is very high. It's probably not going to be a deep recession because we have really strong jobs market, but there will be something. And until we see, speaking of the jobs market, until we see that unemployment rate getting up into the 4 to 4.5% range, the Fed is just not going to stop doing what they're doing. And that's really the reality of it. So we're going to have a reversal of what's going on. We're generating 300,000 jobs a month right now, and that's just not going to work for what the Fed's trying to do. So there will be a recession, and we're positioning for that. So we're getting ready for where we need to be. What are the best asset classes and best places to go in order to ride that out? And so we're shifting the portfolios into large cap stocks, growth stocks. Those are the portion that we have invested is in those. We're also diversifying out. For the first time in a decade at least, we're able to get some value in international markets. So we're diversifying out a little bit into international markets because they're finally less correlated to the U.S. market.
So you're trying to be as much non-correlation as you can.
Yeah, I want to take out of that. Yeah, exactly. So we don't want to get caught up everything we have in one basket. Right. So we want to put some eggs
especially
in other
during
baskets.
The recession.
Exactly.
We want to be diversified outside of the U.S. a little
Exactly. And we're careful of how we're doing that too. We're certainly, China is always a favorite, but China is definitely not a place to be right now. They're really struggling. In fact, their teen unemployment rate in China is about 20%, which is astonishing. So that's an economy that's struggling. So we avoid things like that. But we are looking for places to diversify things out as we get ready to go into that sixth stage.
Well, fantastic, Ron. Appreciate your time today.
Yeah,
as always.
Always fun.
Yeah, absolutely. So, ladies and gentlemen, thanks a lot for tuning in and listening to us at the CFA Corner. I'm Tim Fitzwilliams, Fitzwilliams Financial, and Mr. Ron Wright, Advanced Investing, leader of our portfolio. We hope to talk to you guys later. Take care. God bless.
Bye.